Hi everyone, and a very warm welcome to this Oakland's webinar entitled Exit with Excellence, the Foundations of a Successful Company Sale. I'm Peter Gray, I'm the chairman of Oakland's based here in London. Please make use of the Q&A facility at the bottom of your screen to ask any questions you have of the panelists. So this seminar is the final installment in a series of seminars that we've been holding over the past few months on exit planning. On previous webinars, we've talked about the importance of exit planning, how to choose the best time to sell your business, and how to maximize value on a sale. Today, we're talking about the very important subject of avoiding the mistakes which vendors often make. As usual, we've got a star-studded panel with us today from Oakland members across the globe. So let's kick off by asking each member of the panel to introduce themselves, starting with Maarten in Holland.
Thank you, Peter. I'm Maarten Wolleswinkel. I'm the founder of Oakland's Netherlands. I founded the company 25 years ago. We have a team of 55 people in Amsterdam and sold about 450 companies with the Dutch team.
I'm Joanna Herman. I'm a partner at Oakland's De Silva & Phillips in our New York office, and I'm also the co-head of the technology, media, and telecommunications practice. I'm delighted to be here.
Thank you, Jürg.
Jürg, partner Oakland, Switzerland. I spend 5 times more time on M&A deals than I spend on skis, but I'm working on this ratio. Happy to be with my colleagues and you all in this webinar.
Juan Pablo Bayter. I'm a founding partner of Oakland's Colombia. I've been, as Jürg, also spending a lot of time on M&A. Together in Colombia, we have almost 100 years of experience between the partners, so there's quite a lot of gray hair down here.
Thank you. So let's kick off with our first question. Maarten, what are the most common mistakes that you see in M&A transactions?
The most common mistakes, Peter, are all around optimism of the sellers. What I often see is that company owners are over-optimistic about the way how they can sell their business and whether they can sell it at a premium price. What we often see is they don't realize that the company needs to be prepared for sale. And they think if they have a good company that it more or less sells themselves. But for example, we have seen many times that companies don't have a 3-year business plan, for example. And we all know that buyers buy the future and not the past of a company. So if you don't give an outlook how the business can develop in a couple of years, you miss a huge opportunity to really sell the potential of your business. We even had once, and that's a small example, that made fun, a company owner that didn't have any plan, not even a budget for the next year. So we made a bid book and a 3-year plan, and after reading it, he said, "This is such a nice company, I don't want to sell it anymore."
Fantastic. So, Joanna, over to you. How can advisors help you to avoid the mistakes that we see in M&A transactions?
I think following what Maarten said, what I think a lot of buyers don't realize is that successfully selling a company is very, very different than successfully running a company or even successfully selling your own sales or products for your company. I've seen sellers that are some of the best salespeople I've ever met who are just terrible at selling their own company because they don't understand how to position it and position in a way that will really maximize the value to buyers. I mean, one thing that Maarten mentioned is how important it is to have all your information together, such as your financials and a 3-year plan. But as an example, that also it's getting that analysis ready. Let's say you've had a recent dip in profitability. It's going to be really important to highlight that the investment that you recently made is the cause of that dip in profitability. And therefore, also we can start to show those early growth signs that show, guess what, as a buyer, you're actually getting the benefit of the investment that was made. So you take something that might initially appear negative, and we help you show that it's actually a positive story to buyers. I mean, similarly, if a retention rate of clients has been going down, we might be able to analyze the clients and say, look, if you segment the vast majority of clients are very profitable and their retention rate is going up, And there's a small group of clients that actually maybe we want to sunset. Maybe they're on a legacy product or they're just not profitable. That retention rate is going down. This is another where you're showing a positive story of something that might have on the surface seemed negative. And one other thing that I think is a little less obvious is that I think sellers sometimes want to show that they're doing it all, that they've done everything and they're doing it all right because they're used to sort of bragging about their company. You need to show some opportunity for the next buyer. And that's another thing that we can help finesse, is really helping you understand to show all the great things you've done, but how the next buyer is really going to take it to that next inflection point. Let's say the growth beyond 100 million. This is how the next buyer is going to do that.
Thank you, Joanna. Next question to you, Jürg. What measures should be undertaken to mitigate the risk of a deal not happening, to maximize the chances of a deal happening?
Thank you, Peter. I tried to break it down to 5 measures, basically, to consider. First one, it needs accurate valuation and realistic expectations. Unrealistic valuation expectations can really deter potential buyers and finally hinder the progress of a deal. Second one, identifying and targeting the right buyers. Identify the ones that derive a high value from the acquisition, and also make sure that they have the financial power finally to do the acquisition. Then third, effective marketing and communication is important. Develop a compelling and informative marketing package that highlights the value proposition of your company. Ensure consistency between information memorandum, data room, and management meetings, highly important, but not always the case. Respond promptly and reliably to inquiries, provide requested information, and address concerns or issues proactively. This is very important to build trust and confidence. The fourth one is negotiation with flexibility, with an open mind and a willingness to find mutually beneficial solutions. Flexibility and adaptability during negotiations can help keep the deal on track. And last one, have a contingency plan. Develop contingency plans in case the deal does not materialize. Identify alternative exit strategies or potential buyers as a backup solution. Having contingency plans in place can minimize disruption and ensure a smooth transition if the initial deal falls through. At the end of the day, there is always a degree of uncertainty in an M&A deal. However, implementing these strategies can increase the probability of a successful sell-side transaction and help mitigate the risk of a deal not happening.
Thank you, Jürg. When Pablo, what are the 5 most important elements you need to get right to achieve an optimal transaction?
It's probably a summary of what we've been saying. The first element is preparation. As Joanna was saying, do not underestimate the value of understanding thoroughly your business, understanding your products, your margins, what are your issues, what are your opportunities, and putting everything together in the right package. I think it's of great value. I mean, you have to avoid surprises when you start the process. So the better you understand the company, the better you understand your numbers, your clients, then you will have a better process. The second one is probably the correct positioning of the company. You may be in a situation where your products are going through a slump, but you have new products that are coming to the market. Maybe you have products that everybody wants, and those are the ones that you really have to push forward, and you want to show them correctly to your potential buyers. You need to have those marketing materials that really position your company as the one that is the right champion to tackle these new businesses and new sectors. So positioning is really a key aspect. You don't want to show yourself in a market that is declining, or you don't want to position yourself in a market that nobody really wants. So you have to really understand what the market wants and what are the opportunities of your company. Probably another one is optimal timing. You have to understand the market, what is the right window, when is the right time to come to the market. It may well be that it's better to wait a little bit until some of the tendencies of the market materializes. If you had come with an AI company 5 years ago to the market, maybe nobody would have even understand what is going on. But now it's probably the hottest thing in the market. The right timing, it's a key issue. And that is something that relates to the market, but also relates to your company. You may be about to start a new business plan that is going to drive a lot of growth, but maybe it's what you have now is not enough and buyers are not going to understand it. So you better wait a little bit also to be able to deliver it. Or maybe something is going to happen in the coming future that is going to disrupt your market. So you better hurry up and go to the market before this happens and your business completely changes. Then another one is, as Jürg was saying, reaching the right buyers. Do you have what the buyers want? And if you have it, you have to show it to them and you have to reach to them. You have to go to the buyers that really want what you're selling. So because they're the ones that are really able to pay for what you have. So it's important that they understand that they pay for the synergies that they will be able to materialize when they buy your company. And it's key that you are able to reach to them. And probably the final one that really puts everything together is get the best advisor. Really is one of the most important decisions that you will make in a selling process is getting the right advisor. You have to have somebody that understands your business, that understands the sector you're in, that have the right experience, that have the seniority to have been through a number of different battles and is able to really manage the process to help you tick all these different points that we've been mentioning. So probably if you get the right advisors, you will get everything right.
Thanks, Juan Pablo. So just in terms of Q&A, I've got a question about specific examples of issues that have arisen either before a transaction kicks off or during a transaction, and how have you dealt with those? So, Juan Pablo, why don't continue on with you to give some kind of practical examples of situations that you've come across and how have you dealt with those?
There's a particular transaction that we are very proud of. We advised a company that it was a fairly small company with a lot of ambition, and they came to us and said, "Look, we really want to grow our company and we want to go to the next stage. We're not sure how to do it. Why don't you help us?" And a bit like Maarten was saying at the beginning, we helped them put together a very, very ambitious business plan that basically had a lot of acquisitions in a segment that they were not really present of. It was very hot. It was something related to industrial waste and what the sort of like dangerous waste that needed to be handled, etc. So we put together this plan together with them. And then we decided that we needed to make a couple of acquisitions before, small acquisitions before really being able to tackle the big transaction. So we made a couple of acquisitions. We had them ready, and then we went and brought a financial buyer that was really happy to put the money in to finalize the whole business plan. So we ended up doing 4 or 5 transactions within a term of sort of like 18 months. And I think nowadays is one of the leading companies in industrial waste management in the region. And
there's another question here about getting the right team on board, and Juan Pablo, you mentioned that as one of the most important aspects in terms of getting the right advisory team on board, which obviously not only includes your corporate finance advisor but also a good law firm. Any views on that in terms of who is fit for purpose there, and mistakes perhaps that you or any other panelist sees in terms of clients going for false economy and going for the lowest cost advisor to their peril kind of later in the transaction? Who wants to have a go at that one?
We've certainly seen situations where people have a wonderful relationship with an attorney for many years and they think that can be their M&A attorney. And just as we have talked about all the reasons why a seller can't sell their own company because it's not their expertise, M&A is a very specific expertise. And we also believe that timing is incredibly important, not just in terms of when you bring your company to market, but in terms of how a process unfolds to bring a very successful transaction from the beginning to a successful closing. And if an attorney is getting up to speed, it can cause huge delays. It can sometimes unnecessarily cause conflict between a buyer and seller. And it's not something where someone can just sort of, not have the expertise, but be a very efficient attorney. So we always recommend find an M&A attorney, not only find an M&A attorney, but find an M&A attorney that's right in your sweet spot, not one that's, used to doing deals that are very different than the kind of deal that yours is, because they will be able to foresee behind the next corner what might be one of the roadblocks. And the really good attorneys actually are just very creative, because one thing that we talk about a lot is that very often a deal will get stuck because a buyer and seller want something, and their proposed solution is completely contradictory. But when you really unpack it, what they both want is not contradictory. It's just that they haven't come up with the right solution, and there might be another solution that meets both needs perfectly. And the right attorneys who are used to this will see that immediately, and something that could have delayed a transaction for weeks or even unraveled it becomes a non-issue.
I found out that only 1% of the attorneys understands bookkeeping. And that's what an M&A attorney needs to understand. If there's structures like earn-out payments in the future, if you have to calculate net debt positions and all kinds of stuff that comes into the dirty details of a deal, you need an attorney that is really on top of it and only does M&A deals the whole day, instead of being a friend of the family and doing some stuff for many, many years. That doesn't help at all.
I totally agree with that. And we see it, as one of our most important roles is to make sure that our clients have appropriate attorneys on board. Not kind of provincial lawyers or two-man bands where the answer phone comes on at 5:30 in the evening. They need to have done a lot of M&A transactions of your size, preferably in your sector, because there are legal nuances in every sector, and they need to have all the disciplines kind of covered off in terms of kind of corporate, employment, banking, etc. We've seen some kind of real horror stories where lawyers have been engaged that we haven't been able to wean our clients off our local lawyer, and it's resulted in an absolute disaster. Sometimes it can delay the deal because the lawyers are not sufficiently well resourced, and of course, if there is a delay in a deal, it could result in the deal not happening at all, because there are kind of myriad things that can happen which can upset the apple cart, either within the business in terms of a downturn in trading performance, or something left field over which you've got no control, a stock market crash, COVID, something like that, a black swan event. Transaction speed is hugely important. So both your corporate advisors and your lawyers need to be able to move at pace and be sufficiently well resourced. I've got another question here in terms of do you see deals collapsing because of a fallout with the buyer, between the vendor and the buyer, and the answer is absolutely yes. And one of the mistakes that we often see, which results in a deal collapsing, actually is a big fallout between the vendor and the purchaser during the latter stages of negotiations and due diligence, typically. So during the initial stages, it's a real kind of love-in, and the buyers are courting you. They want to make out that they're leaving price to one side. They are the best owners of your business. They would be a good home for your business. It's an emotional sale for our clients. They want to see the business going to a good home. So the initial phase is all very friendly, but when you get towards the latter stages of a transaction, and you're giving exclusivity to a particular purchaser, and they bring in their heavyweight kind of legal advisors and financial advisors who are asking lots and lots of questions, sometimes kind of tensions can arise. And sometimes our clients think, this line of questioning from a purchaser, they're challenging our honesty. They're looking for skeletons in the cupboard. The answer is no. They're just doing their job. Sometimes we see a purchaser change their negotiating position on a particular issue, and the vendor is very upset by that and kind of accuses them of bad faith. We see this all the time. But the worst thing possible is for tensions to arise to such an extent that the deal collapses. So the important role of the advisor is to act as a buffer between the vendor and the purchaser, and conduct all the tough negotiations, and make sure that our clients, the vendors, maintain a really strong relationship with the purchaser during the transaction, and there is no kind of massive fallout, because that can be fatal to a transaction actually happening. And we have to advise our clients that all of these things are a very normal part of any transaction, and just ensure that that relationship is maintained and the deal closes to the mutual benefit of both the vendor and the purchaser. But the transactions are emotional affairs. For most of our clients, it's their baby. They've built it up over kind of 10, 20 years often. So emotions can be very fraught, and it's very much the role of the advisor to calm any kind of tensions that arise during the process, inevitably. So Maarten, why don't you give us an example of the situation you've been in, where there has been an issue potentially which could have meant the deal not happening. The owner's made a mistake, one of the mistakes you talked about, and how you kind of overcome that mistake, remedy that mistake, and the deal's actually kind of gone through.
Well, there's so many mistakes that you can make, but if you just look at what you can do and prevent by doing a good preparation, like Jürg was already mentioning, then you can basically cover all the potential mistakes that could be there. What you see is a seller always wants to believe what he thinks himself is the best outcome of a process. So if there is a buyer that says, look, I'm really interested to buy your business. We are the right parent company for your business. We can do a fast process. We offer you a top price. Then, of course, a seller hears everything he wants. It's a fast process, it's a top price, and limited due diligence. In exchange for that, such a buyer wants to have exclusivity. Said, look, we want to have exclusivity, 6 months, and then we do the fast process. And then during the process, the buyer starts to ask questions, and then, for example, questions about working capital, and then it appears that the company is not able to deliver any figures on an average working capital that is needed to finance the company, and then it becomes clear that the company is not really ready for sale, and then a buyer who is in an exclusive position will say, look, and we need more time, or we lower our price. And what we often see is that sellers in the end get very tired of a long process, and then they are inclined to give in to these buyers. And in the end, an unprepared process takes often longer than a well-prepared process. Sometimes it takes us 3-4 months to prepare a company for sale. But then you can be only 6 weeks in the market, and then you have the signatures and everything is done. You could also say we give somebody exclusivity and wait for all the questions to come, and then answer these and become more vulnerable down the road. So it's just an example about preparation.
Thanks, Maarten. And yeah, you must have seen situations where your client or a potential client is approached by a potential buyer. They put a price down on the table, and the vendor in question decides, well, why do I need to engage expensive advisors? I can do a DIY approach and handle negotiations myself. What are the dangers and the pitfalls of that approach that you have seen?
In fact, that happens quite often, that we see that we are involved in transaction a bit late when the seller already tried to enter a sales process himself. Typically, 1-2 interested parties knock on the door, and he thinks he can do the process alone, but it needs preparation, as Maarten just said. And when the worst case that we often see is the seller already provides financial information to the potential buyer in a very early stage, and typically these financial informations are not prepared. They are not normalized. No adjustments were made. What we do when we prepare is we take non-operational expenses out. When excessive salaries are in the income statement, we replace them by market salaries. And every dollar that you save there times the multiple impacts your price. And when these financials are already out there, it's a bit harder then to come with a different set of financials at a later stage. And it impacts the price, but it only also impacts credibility, especially when the financials then turn out not to be right. And what we do in a sales process, we make sure from the beginning that there is consistency from the financial information memorandum to the data room, that there is all consistency through line. And when you're not consistent, you lose trust. And that's why preparation is so important.
One example I have on that particular aspect, we had this company that came to us, and they had already agreed a price. They had given exclusivity to the buyer, and they came to us, and so we had to go back to the buyer and say, look, wait for a month at least. We're going to review everything. Just be a little bit patient. And we ended up with I think it was like 60% higher EBITDA because obviously they didn't normalize anything. And then we increased the price by 5 times. And obviously took a lot of negotiations to explain the buyer and to get him to pay the 5 times what he already offered. But otherwise they would have sold the company for a fraction of what it was really worth.
Yeah, and I would add to that, it is a real danger, to Jürg's point, if you've been approached by someone and they put a number on the table, to assume that is the best that you are going to get without actually testing the market. How do you know that you're going to max out on value by engaging with that particular purchaser? How do you know there's not an overseas buyer that would pay another 2 times on the multiple? So there will be occasions, and Joanna and I had a deal a couple of years ago where involving Reuters Thompson, where the cold approach that was received was just inevitably going to be way ahead of the next best offer. We did test it to some extent, but generally speaking, there will be others out there who will pay as much, if not more, without going to see an advisor and asking that advisor, what does the market for my business look like? Who will be the interested parties? What valuation metrics apply to my business? I think you're not going to kind of max out on value. So absolutely worth, in almost all cases, kind of testing the market. But one other aspect advisors can add real value to the price is not just in terms of negotiating the headline price, but negotiating the highest possible number for surplus cash on your balance sheet at the time of the sale. Joanna, do you want to pick that one up in terms of how we do that with lockbox? Not going into any great detail, but just the nuances involved that a vendor would not necessarily see.
Absolutely. I mean, first, just to echo what you said initially about our ability to drive up a price. I mean, I think just when you hire a banker, it signals to the buyer that there could be potential competition, and you should never underestimate what that means to a buyer, because suddenly they will often have to put into their model that they're doing to see what is the maximum price. And I started my career on the buy side, so I always imagine this huge spreadsheet they have, and they're looking at how much can they pay. And they can also factor into that, if their competitor were to buy you, what would that mean in lost sales? And really gives them the opportunity to maximize way beyond what they potentially would by adding in revenue synergies, many other aspects that, I think a good banker can collaboratively work with buyers to help them drive up those prices, to help them understand, here is the story that you need to pay the maximum price, and also remind them that if they don't, there are other buyers out there that will. And that's just something you as a loan can't do without an advisor. The other piece that Peter just spoke to is really understanding the importance of other pieces of the consideration. And one is working capital, which I believe is what you were speaking to, and how much cash is left. And this could have a huge swing, because in many, depending on the type of business you have and how you run your cash, and as Peter said, not without getting into the details of the calculations, but it can have millions of dollars of swing depending on if you're running on a negative cash balance because you're getting, upfront yearly payments that then you're using to drive a lot of your operations, to drive how you manage your cash. You have to think about, how does that all factor in to what the total consideration is, and things like that. I think, if you're not working from the very start with a good banker, can become huge problems later, because you've agreed to a deal that says it's going to be, there's going to be no cash, and you start to realize that, wait a minute, we need to have a negative target that we didn't put in there.
Maybe I can add to that. What we often see is buyers always, of course, make an offer, a debt and cash-free offer. That's the normal in the market. That's how it's been done. But a debt and cash-free offer, of course, can mean a lot. But if we look at the balance sheet of a seller, what we often see is there are also non-core assets. And these are assets that are owned by the company, but don't produce, let's say, EBITDA, or don't produce profit. And that can, for example, be a plot of land, a huge plot of land that you have bought because you want to buy a new warehouse or build a new warehouse on it. We had recently a client that had all kinds of loans to his distributors on the balance sheet, because he just helped these distributors to start the business of a new product. And if you look at it from a debt and cash-free perspective, these are all this is debt money. So that means the buyer actually doesn't give a penny for it. So we advised in this case the seller and said, look, why don't you keep it and take over these non-core assets with your holding company for €1 or whatever it's on the balance sheet. Then it turns into cash in the company that you are selling, and the cash is in the cash and debt-free calculation for you anyway. So in these ways, you often unlock millions of money. That are just in the definition of a purchase price. And there's much more to that. But of course, there's more on the panel that can add to that.
Absolutely, Maarten. And indeed, you talked about kind of surplus property, surplus assets. Sometimes it's consistent with maximizing our value to take out the property that's actually used in the business, where the business premises is located, manufacturing facilities are located, for the vendors to take that out and just prior to the sale, and then enter into an arm's length lease with the purchaser. Again, the advisors are there to do the maths on that and to work out what maximizes value for you as a vendor across the board. And Pablo, anything to add on that?
We had this particular transaction where there was this retail chain that came to us. They wanted to sell the company, and they own this large number of stores in really prime locations in the country. When we were doing the whole analysis, it turned out to be that the real estate was much more valuable than the company itself. So yes, there is a lot of value hidden in the company that you may not realize if you don't prepare and you do the analysis. In this particular case, we ended up selling the real estate, and they basically closed down the company, and it was a bit extreme, I would say. But there is a lot of value hidden in the companies that you don't see it normally, and probably your advisor will be able to unlock it.
Fantastic. Guys, I think unfortunately we've come to the end of the session. So a big thank you to our panelists today, but also to everyone who's attended this session and indeed the previous sessions. As I said, this is the last of our sessions on exit planning, but I'm sure that we will reproduce these sessions in the future, and we would love to see you on those. But from all of us, thank you very much, and have a good rest of the afternoon, or evening or morning, as the case may be. Thank you.